So as we get officially started, I'd like to welcome you all again to today's webinar. This webinar is titled Three Strategies to Protect and Grow Your Retirement Nest Egg. So as we go through here, we're going to walk through some very important points, or at least I think very important points to, again, building and managing your retirement portfolio. And I want to show you the three core strategies, as the title of the webcast is. So if learning about these things is good to you, now is a great time to turn off all your distractions. Okay, we don't want you to be distracted. We want you to pay attention, have a notebook, take some notes, jot down some questions for later on. We'll have a full open Q&A. So be able to do that and close your door, turn off cell phone, or at least put it on vibrate. If you got other windows on your computer open, shut those down. I don't want you to miss anything. I think there's going to be some good stuff here. So let's go ahead and do that. First, let me introduce myself. My name is Jim Penna. I am the manager of retirement services here at VectorVest. I've been with VectorVest for about the last 14 years or so. Back in a long time ago, now it seems, I moved my family. My two boys were very young then, from the Connecticut area down here to North Carolina, the Charlotte area, and found VectorVest and been very happy since. So prior to that, just to give you a little background, I was a market maker on a large trading floor up in the New York area. Before that, I worked on some smaller trading desks in New York and the like. So I took my Series 7 back in 1992, so I've been in the business a long time. And again, that was two lifetimes ago. As I said, I was a police officer in Connecticut before that. So if at any point during the webcast it sounds like I'm telling you what to do, that's that's where it comes from. So all right. So let me go ahead and get started from there. Now, we're in the VectorVest Retirement Services Department or division. It 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 began a while back, and I've had many conversations with our founder and mentor, and I'll talk about him as our hour goes through, Dr. Bartolito. And when we were building a lot of the foundation of what we do here, I relayed to him that when we used to go on the seminars on the road and all, the main question I used to get, and still get to this day, in some form or fashion, it may not always be posed exactly like this, but the question always is, how do I keep from running out of money in retirement? Okay, how do I keep from running out of money in retirement? And, after chatting with Dr. D about all this, he said, in only the way that Dr. D can, he said, James, because he always calls me James, he said, James, tell him to just keep making more money. And so we kind of took that concept and created where we are today in our retirement services on how you can continue to do that. Because here at VectorVest, we really believe, in our promise to you, or our goal for you, I should say, is to ensure that you can retire with a peace of mind, knowing that you can steadily grow your portfolio, that you can generate income, and as I'll uh, illustrate later, and what's most important to me is preserve your capital. Right. So those are the three core strategies, and those are the three core points of what we want to focus on today. We believe that a secure retirement is one in which you have enough income to live the life you desire. And we use kind of the cliche of, floating around in your yacht, and these nice folks here actually, as you can see, actually name their boat the VectorVest. We believe that a secure retirement is one in which work is optional and retirement is affordable. Okay, that's what we believe is the foundation of a secure retirement. Now, that peace of mind I was talking about, what do I mean by that? Well, what we do is break these three core strategies down into what we call the three P's. It begins with profit. In other words, simply capital appreciation, growing your portfolio by simply buying good, safe, quality stocks in a rising market. That's one of the we kind of fight this battle on three different fronts, and that's one of them. The second P is to provide, and by provide we mean a safe, steady income. Okay, that's front number two, and then as I mentioned and will mention several times, capital preservation. Okay, protecting your net worth, your nest egg. That is the key. So what we want is the ability in your portfolio when it comes to capital appreciation that, as we've seen over the last few months and we've seen in the last year or two and we'll continue to see as long as the markets are open, we've got a roller coaster that we want to turn into a nice steady climb. Right? There's always going to be some volatility and some drawdown, right? Your portfolio sometimes will have uh, these movements in it, but we don't want this violent, steady movement. We want a steady climb. On the provide side, we don't want you having some random, stock that may pay a dividend and you've got some income trickling in. Our goal is to turn that income into a steady flow. And then finally, you have to be prepared. And it's as simple as that, being prepared when the markets turn against us. Okay, turn against our retirement portfolios. We want you to go from being unprepared to prepared. So that's going to be our goal today. Let me just take 1 second and ask you guys to type in to the chat box here, if you would, what's the hardest part about preparing, or if you're already retired, about being retired? What's the hardest part about preparing for retirement? I'm going to ask throughout the webcast to do a little interactive, just so I know we're all on the same page. Curtis said, "Yeah, started saving too late." Yeah, that's a hard part. That's why this, Curtis, may be very important to you. Walter says nothing. Well, that's the perfect answer, Walter. James also says no problem. John says too many options to choose. They're coming in fast, so it's hard for me to read. Grant says knowing how much you need. Yeah, that's a tough one, and there are a lot of ways to try to balance and figure out an allotment there. Knowing tax implications, Douglas says. Yep. Rosalina says one again. Just as I opened with the conversation with Dr. D, running out of money, right? That's a huge worry. Donald says he prefers non-dividend growth stocks. So finding those good growth stocks. Donald, you're in the right place here today. I'm going to show you how to do that here today. And again, you don't have to apply all three of these major core strategies. The idea is what suits you and how you go about doing it. That's going to be an important part. Okay, wow. So a lot came in. Well, from what I'm reading through here, I see that I believe you guys are in the right place for the type of things that we're looking at here. So let's go ahead and move on. So when I talk about the three P's, let's break it down even further, right? We talk about capital appreciation that's growing your portfolio. I talked about income. Income is going to come from two sources. We are going to talk about dividend income, and we're going to talk about generating income using covered calls. And then, of course, we're going to focus on the most important portion of all of this is capital preservation. Okay, let's start with capital appreciation. Let's start there. And again, that first P, profit. Capital appreciation comes from owning companies with consistent and predictable financial performance. Consistent and predictable. And so I often like to ask, what two better adjectives are there to describe the stocks that live in your retirement portfolio than consistent and predictable? Okay, that's what we're looking for when we talk about capital appreciation. Dr. Delito said that and it's written and said many times, good portfolio management, it starts with buying the right stocks. And so I use the analogy, and I'll use the baseball analogy several times throughout the next hour or so. Okay. My favorite team is obviously the Mets, 1969 World Series champion. So when we talk about building a portfolio with buying the right stocks, I look at it as fielding a team, right? You have a roster, you put your team on the field, you put the best performers on the field. Okay, that's the idea here. So if I'm building a team, I want Tom Seaver and Cleon Jones, Nolan Ryan, and Tug McGraw. I want all of these guys on my team. I'm putting the best guys on the field so that I can win. And so it's very similar when you're building your portfolio. So that's the first baseball analogy that we use. And you can fit in any sport or team that you want. But the idea is if you've got a second baseman who's striking out 3 times a game and making 2 errors a game, what do you do? What do you do with that player, right? You bench him and you put in another player. And sorry about that, Steve. Steve said, he was an Orioles fan in the 60s, and that's who the Mets beat in the 69 World Series. So sorry about that. Anyway, all of that begins with investing in safety first. Okay. Primarily, our growth portfolio, you want to look at the company's safety more so than anything else. To continue the baseball analogy, while it's always fun to hit the home run, buy the cheap stock and hope it, you hit that 10 bagger as they call it, and the stock just, goes crazy to the upside. That's great. If you got a portion of your portfolio that you want to do that in, wonderful. But that's not what we're here to talk about today, because we know what happens to home run hitters when they don't hit a home run. Okay? When they don't hit a home run, and that is usually they strike out. So that's not what we're looking to do here. When we talk about stock safety, there's a checklist that we use, and there are specific characteristics that we look for. Earnings consistency, company size, price behavior, longevity, history, and dividend history, and debt to equity ratio. Now, just quickly, company size and business longevity. I'll just comment on these quickly and focus more on the others. Company size, keep in mind, just the takeaway there is that just because a company is large, a big company, doesn't mean that that company is safe. Think GE when I talk about something like that. Right? Just because it's a large company doesn't necessarily mean it's safe. And Dr. Delito has commented on business longevity, and he used the phrase, better the devil you know than the devil you don't. The longer a company's been around, that's a positive. That's a box checked for us. Companies that have been around longer. So this is the stock safety checklist that we like to go into. Now, if you go out on your own and you try to find that information for individual stocks, you're going to get buried by a lot of data. It's going to, you can do it, but it's cumbersome and it takes a lot of time. All right. So what we've done here at what Dr. Delito has done here at VectorVest and in the VectorVest program is we've created an indicator called relative safety. And again, the definition of relative safety in the VectorVest program is consistency and predictability of the financial performance. Okay? Those are the primary factors in assessing relative safety. And what we do with virtually all of our indicators is we put them on a 0 to 2 scale. So when we look at whether it's relative safety or value, or whatever it might be, it's on a 0 to 2 scale. What we're going to focus on is somewhere between very good and excellent when we look at relative safety. Actually looking more towards excellent. Okay, but this is just a basic breakdown of the VectorVest program, the ability to take information, funnel it into the VectorVest program, and then have come out at the other end of that funnel actionable information rather than just data that I'm going to try to analyze on my own. And that's what comes from these numbers. So when I go back to the safety checklist, it's so important that I want to focus just for a minute on 4 of these important factors on the checklist. So let's start here with a graph of West Pharmaceuticals. Okay, this graph, this stock, as of just, not even a week ago when I built the slide, had a relative safety number of 1.45 on that 0 to 2 scale, which is excellent in the VectorVest program. What happens when we look at stocks with a relative safety of 1.4 or greater, or close to 1.4 work as well, is the patterns on both the price of the underlying stock, and this, by the way, is a 5-year graph of the underlying stock. And then we have graphed here is the earnings per share as calculated by VectorVest using a formula that looks at both historical and forecasted earnings. So 2 of the characteristics on our checklist, number 1 is price behavior. This is the type of stock that we look for in our retirement portfolio to populate our portfolio. Again, this is the building part of the portfolio. Even these drawdowns, no stock is going to go absolutely straight up. Without even looking at the dates at the bottom, the first time I brought this graph up, I knew this was late 2018, and that's exactly what it is. If you remember, we'll talk about it later, the sell-off in 2018, of course, what we've recently gone through, but the stocks are resilient because they're high RS stocks. And it's the same thing on earnings per share, and what I often say, it's not by coincidence that the stock price has risen as to have the earnings per share, consistent, predictable performance of the underlying company. So there's your price behavior and your earnings consistency. That's what a high RS stock looks like. Now, we also talked about dividend history. Now, to be a safe stock doesn't mean you have to pay a dividend. Doesn't mean you have to pay a dividend. However, if the company does pay a dividend, they darn well better continue to pay it and continue to grow it. Now, I know we're in a unique time before anybody types in questions. I have to stay on top of it, and it's happening as we speak. Some companies are suspending or their dividend or cutting their dividend, and that's something we have to keep on. But that's happening in real time. But generally, what we want to look for are companies that have a consistent uh, growth in their dividend over the years. Now, this is just still a 5 year look back. If I take West Pharmaceuticals out to 25 years, I'm going to see one stretch where they actually held a flat dividend for almost a 2 year period. Otherwise, they would make it to what's called the dividend aristocrats. They kind of just barely miss out on that. But they've never had any, suspension of dividends over the last 25 years, haven't had any uh, drawdowns in the dividends. So this is what we look like, what I like to call the golden staircase. So that's the dividend history, the price performance, the earnings consistency. This is what high RS stocks look like. It could be West Pharmaceuticals, it could be Ross Stores, it could be any number of stocks that we'll talk about as we go through. Now, the next part of the checklist for stock safety was debt to equity ratio. Why is this important? Well, these current times are a good example of why it's important because what we need to be sure of is that the company has a strong balance sheet. That's important because there are headwinds, there are roadblocks like we're seeing now, and companies struggle. That's always going to happen, whether it's the current conditions that we're facing, the coronavirus, or something else, whether it was 2008 or whatever it might be. The companies that have a strong debt to equity ratio, which is shown in the high RS stocks, are more likely to be able to make it through these headwinds than stocks with weaker balance sheets. So again, we take that information and we funnel it through the relative safety indicator so you don't have to. Okay, so you don't have to. Here is a search called ruler stocks. And someone, I didn't catch the name, but somebody typed in earlier, how do I find these type of stocks? He wasn't worried about dividends, he was worried more about growth. Well, the VectorVest program has several great searches. The one, and I'll tell you now, is my favorite one, is called ruler stocks. And by simply going into what is our Unisearch tool, in our prudent folder, it's a search called ruler stocks. And there are very basic parameters are that define what stocks come onto this list. It begins with earnings growth rate. When you see GRT, that's earnings growth rate in percent per year. And the relative safety has to be greater than or equal to 1.4 on that 0 to 2 scale. Now, don't worry too much about these other numbers. They're just some basic things that are in most of our searches. But these are the key factors in this particular search. And then we have what is called the sort. How do we rank these? And we take relative safety times the earnings growth rate. Those are the stocks that come to the top of the list. And I ran this, took a screenshot just not even a week ago. And these are the stocks that are currently at the top of the list as of about a week ago. Now, this particular list doesn't change a whole lot day over day, but it certainly can. But you'll see the relative safety number that's found there, all very strong stocks. And this is the search that I like to use. I'd like to take, just 30 seconds out and tell a story about, I don't even know how long ago it was now. I think we were in Denver. And this is when we went on the road to conduct our seminars, in hotel ballrooms and things. And so I'm there getting ready to start a 2 day seminar. And there was a gentleman in the crowd who, during the first break, kind of approached me, and he was very unsettled. He looked like he hadn't slept in a couple of days. Maybe he had about a gallon of, caffeine in him, coffee. And he handed me this wrinkled up paper, and he said, "Hey, listen, before I came to this thing, I went out and I did my research. I'm a fundamental kind of investor, and these 8 stocks came up as the best stocks. How's VectorVest, before I sit here for 2 days, you tell me, how's VectorVest going to help me find these stocks?" And again, he was a little edgy, but I sat him down during the first break, and I simply brought up ruler stocks. This particular search, I clicked on Unisearch, and I brought it up. He had 8 stocks. 6 of the 8 were in the top 10 of ruler stocks. 6 of the 8, with one click of the button, he was able to find. The other two, I think, were like number 11 and 12 or something like that. It's a story I like to share because, first of all, it's a true story, and second of all, it just is it puts in a nutshell the power and the importance of relative safety. So this is the search. A lot of folks, and I got this question recently in a few different webcasts that I had done. People ask, why are they called ruler stocks? What does that mean? Well, just as a piece of information, they're called ruler stocks from the old idea that, whether it's price or whether it is earnings per share, that you can kind of put a ruler down and draw that straight line, that straight, what I call this northeasterly direction on both price and earnings per share. So that's, in case you were wondering, that's why they're called ruler stocks. You have that nice steady upward movement on both price and on earnings per share. So as we talk about growth stocks, growth portfolio that focus on high safety stocks, I bring you to one of our, I'll call it a master portfolio, I guess, or a model portfolio of ruler stocks using a specific exit strategy and risk management techniques that began in January of 2017. That's why I labeled it just 3+ years, going on almost 3.5 years now. But this portfolio has been managed again using our Profit Locker Pro stop criteria, and it's up 80.21%. Currently, there are no positions because they were stopped out after the sell-off. And I know this is what's catching everyone's eye, and I'm going to address that before we're done here today. I know that is catching everyone's eye, but hold off on that. We are up 80%. We are currently in cash in this portfolio. That's an annualized rate of return over that 3+ years of 24.6%. Currently in cash based on the risk management and the portfolio management techniques. Now, just to put that into some perspective, over that same time frame, I have both the SPX and the SPY, because most people consider that the overall market or the comparison is up just 8.43%. Again, that's as of just about a week, not even a week ago. 8.43% on the SPY or the S&P 500, and this portfolio is up over 24.6%. That's with this drawdown, which I haven't even begun to address the mitigation techniques that we will use. Okay. So that's a pretty telling picture of the power of ruler stocks and high safety stocks. So I'm going to take a quick sip of water and ask you guys to type in to make sure you're with me. Let me ask you this. Would you rather have a portfolio full of stocks with this nice steady northeasterly direction of earnings per share and price, or would you rather worry about the ups and downs that a lot of folks see when they don't have the proper stocks or the proper players on the field? Right? Ollie says absolutely. Bob says, yeah, absolutely. You'd rather have that safe, steady climb. Again, even with the drawdown we saw, and I'll address that in a moment. Great. Thank you guys for typing in. Yeah, it's good. I like to stay interactive. Yeah, and we know the answer, right? But sometimes it's just good to say it out loud or type it in or whatever it might be. But that's what we're looking for. So that's how we grow our portfolio: capital appreciation, buying the proper stocks in a rising market. Next, I want to go to the second core strategy, or at least part one of the second core strategy, which is generating that safe, steady income. Remember, we're fighting this battle on 3 different fronts. So I'm going to switch gears a little bit and I'm going to talk about income. So that's, remember, the provide portion of our triangle, steady income flow. We're going to talk about both from dividends and covered calls. So part one of steady income flow comes from dividends. And Dr. D has written and said many times, in only the way, again, that he can, he'd written in Stock Strategies and Common Sense, he said, the best of all worlds, collecting dividend checks while prices of your stocks go up. It comes from finding solid growth stocks that pay dividends. VectorVest is ideally suited to find these babies. And yes, he speaks the same way he writes. So let's talk about getting paid. Right? How do we build that safe, steady income? Well, you can go into Google and you can Google whatever you want to type in there, good dividend stocks, whatever it might be, and you're going to get, what is that, 850,000 results or more. And anything you get is going to go straight to ranking these by the highest dividend yield that's out there. Okay, that's not what you want to do. Right? So it doesn't matter where you go. Now, there's a Nasdaq site, high dividend stocks by yield, and they're going to keep showing you. Just because the yield is high doesn't mean it's the best quality dividend growth stock that's out there. Don't Please don't fall into that trap of just chasing the yield. So what we have in VectorVest is the ability to go in and use and find the very best characteristics of quality dividend paying stocks, dividend growth stocks. And in the VectorVest spreadsheet, whether you're in a Unisearch or our stock viewer or a watch list, whatever it might be, we have our spreadsheet and we're able to, in the spreadsheet, focus on the important characteristics of a dividend paying stock. And I've got them framed here. Again, we said earlier, growth rate, that's earnings growth rate. DG is for dividend growth rate. Dividend safety, this is the one indicator in VectorVest that's actually on a 0 to 99 scale versus 0 to 2. Here, of course, is this simply the dividend paid. This is the annual dividend paid. And then, of course, based on the current price, and this was again just last week, we have the current dividend yield. What is that stock yielding based on the current price? VectorVest has an indicator called YSG, or yield, safety, and growth, where it takes those three important components and puts them into one indicator on a 0 to 2 scale. So, of course, we're going to favor anything above 1. And I just glanced at the question board, and somebody did mention, and I'm glad you did because I was going to bring it up, that the relative safety numbers on these stocks are lower. Okay, remember, I switched gears when I went from capital appreciation, safe stocks for the growth of your portfolio. Our objective here is a bit different. What you will notice, I'm sure, that all of these companies are recognizable names. Why? Because they are mature companies. They've been around. They all have a strong, steady free cash flow. I know that because the dividend safety numbers are strong. I know that because the dividend growth rates and the earnings growth rates are positive, and most of the top ones in double digits. So a good point, relative safety. These are not growth stocks, although I will show you how you can garner capital appreciation from these as well. But it's a good point. Relative safety is not our first goal here, and I'll show you some of the results when we do this as well. But here's where you get that information. Now, just like ruler stocks in the program, there's a search called blue chip dividend payers that I created after speaking with Dr. D for a special presentation a couple years back, about 3 years now. And I made it as simple as possible. Blue chip dividend payers come from Dow Industrials, Transports and Utilities, or the S&P 500. They have to pay a dividend yield at the time you run the search of at least 3% or greater. Otherwise, they don't make the list. And then we have what we call the DRIP watch list. The DRIP stands for Dividend Reinvestment Plans, which most, I'll go on a limb and say all companies in the industrials, transports, S&P 500 will have dividend reinvestment plans. The 10 to 24 years means that these stocks have not only paid but have grown their dividend for that time frame. And then there's the DRIP 25 plus, which tells us that we have stocks that have grown their dividend for at least 25 years or longer. Again, not just paid, but have grown their dividends. These are the type of stocks we're looking for this portfolio. And then finally, dividend safety plays a very important role here. Again, on the 0 to 99 scale, 50, anything above 50 assures me of what's called the dividend payout ratio, that it's going to be a favorable payout ratio. Let me just go back to this slide real quick. So if I look at the dividend yield versus the earnings yield, you can do this with dividend versus earnings per share if you want, either way. But the dividend payout ratio is simply how much is the company earning versus how much are they paying in dividend. And it only makes sense that I want my earnings yield to be greater than whatever the company's paying in dividends, because if they're paying more than they're earning, eventually that dividend's going to disappear. It's too good to be true. Okay, so that's what we mean by dividend payout ratio, and that's where dividend safety comes in. It will ensure that positive dividend payout ratio. Okay. Here's some examples. T. Rowe Price was on this list, right? It's the number 2 stock. And it's just one I choose because I actually own that in one of my more prudent portfolios. It's what's called a dividend aristocrat, an S&P 500 company that again this is a 25-year graph of a company that has not only paid but grown their dividend every year for 25 years or greater. This is the kind of stock that we're talking about when we talk about building a safe dividend growth portfolio. Over on the right, we could see all of the dividend information that I had on the spreadsheet. Earnings growth rate is strong, dividend growth is strong, the safety is well above the 50 mark. Okay, so all of that information is available to you. And again, the golden staircase. Kimberly Clark, I use as an example as well. Over 25 years and longer, they've grown their dividend. I use this one because it is in a current model portfolio that we use in our Tuesday coaching sessions, and another strong dividend payer. So this is what we're looking for when we talk about the steady income and growth from dividends. And once again, all of that information is there. Now, the same as I showed for the portfolio for growth, and I should have taken that word, although we could talk about dividend growth. I should have taken that word out. So a portfolio focused on dividend growth stocks. Now this is a little bit of a longer period because we are looking at the long term here. Of course, we're talking about retirement. We're not looking at day trading or swing trading. So I run back tests and build portfolios basically on a 1, 3, and 5 year basis to run the tests and get a sense of the efficacy of the system. Some of them I go to 7 years, something like this. I go to 7 years because it's a little more longer term we're looking at. So what you see here is a portfolio that in just over 7 years, again, this is just the stock performance. And yes, I'll get to the drawdowns in a bit, but this is just the stock performance. It's up, I'm going to call it 95%. That's capital appreciation. That comes to I'm going to take the liberty of rounding that up to 13% per year annualized rate of return, which is again pretty good. If we put it in context and I run the same quick test that I did on the growth portfolio, you'll see over the 7+ years there's a 13.5% return on the S&P. So we're doing just as well as the S&P 500 just on capital appreciation, but and I didn't put a space there. What you need to do is add over $30,000 in the dividends that were collected. It's probably up, and I've calculated this up till a few months ago, it's probably closer to 32,000 at this point. That is not reflected in this number. So add another roughly 30 grand on top of that. You're looking at what, 225,000 value on the account, roughly, if I'm doing my math right, give or take. Okay, so when you add that in, and what I'm not taking into account, even after adding these dividend payouts, is the reinvestment of those dividends. If you were to do that, okay, if you were to do that, so you'd also have the dividends. And just a quick comment: yes, the SPY does pay a dividend as well, but it is less than the dividend. The blue chip dividend payers from our search before. Okay, so it is greater than it. So now you're looking at an 18% return, roughly, when you add in the over 30,000 in dividends, and that doesn't include the dividend reinvestment that you may choose to do. Okay. So again, that's coming from a very in a loving way. I call it a very boring portfolio. There's not a lot of activity that goes on there, right? But we can protect again from that drawdown. And that's what we're going to talk about as soon as I get through part two of our income portion. Okay, so we want to be able to in more than one way provide that steady income we were talking about. Okay, so there's got to be a steady income flow from dividends, and then I'm going to talk about covered calls. So that's going to be part two of our income flow. Now, if you don't trade options, or if you're not familiar with options, that's okay. What I'm about to talk about for the next few minutes is two very basic, probably the most popular option trades there are, and that I believe every retiree must know. It's essential to be able to protect and preserve your net worth. They're not hard to figure out, so stay with me as I walk through what we do here for a covered call. Now, what do we do with covered calls? Well, they provide income. And we talk about, the Monopoly game. Remember in Monopoly, you buy a hotel or a house there, you put the houses up. If somebody lands on it, they owe you money. They pay you rent because they landed on your spot, on Boardwalk or Park Place, whatever it is. Right? Think of it that way. You own a stock. Selling a covered call simply means that you're charging that stock rent to live in your portfolio. So try to look at it that way. Another way to define a covered call, whether you're new to covered calls or not, this is still to me the most logical, most straightforward definition of what a covered call is. And it was written by a gentleman named Lee Lowell in a book called Get Rich with Options. I believe Dr. D had read the book and kind of, you know, we used the book to talk about the power of covered calls. There were some other trades in there, but what this gentleman said, he was a option. He worked in the option pits as a market maker for options, and he wrote a great book. And here's how he defines a covered call. And you can read through that. I've highlighted the part that I just love this. He said, there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. That's what selling a covered call is. You're selling someone else the right to take away your stock at a higher price at a later date. And you're getting paid for that. I'm going to show you what that looks like in just a second. Here's a quick description. I'm going to talk about what's called the buy right. You buy the underlying stock and then you write or sell the covered call against it. Write and sell are synonymous in this case. So you buy the stock and you write the contract. You can also sell one call option against every 100 shares of stock that maybe you already own. And there are different objectives behind that. But right now we're talking about generating income. Here's what it looks like. Let's say you go out and you buy 100 shares of XYZ and you pay $60 per share. At the same time, you sell a call option. You sell one XYZ with 45 days to expiration. That's the expiration date. And you sell the 62.50 strike price. That's the price you agree that the buyer of the call option can take away your stock at 62.50. You own it at 60 and you're getting paid $2 for someone else to take your stock away at 62.50. Now, what that does is leave us with a net debit or a cost basis of $58 per share. Right? I paid $60 for the stock. I got paid $2. That means I spent $5,800 for that 100 shares. Let's go over a couple of quick what ifs. Well, at expiration, if XYZ is above 62.50, then my objective has been met. That's my goal. Why? Because what happens is, remember I paid $58. I'm going to make $4.50 per share, which is a 7.7% return on investment in just 45 days. Right? Think about the dividend stocks that we just talked about. And you should have a good quality dividend portfolio, I believe, for the long term. But here in 45 days, if you had a stock that paid 7.7% over the course of a year, you'd be ecstatic. That's a great dividend yield. But here we're doing it in 45 days, and that's just one trade. However, there are some other what ifs. And so what if XYZ is below 62.50 at expiration? Well, remember, we're long the stock at a cost basis of $58 per share. That's 3% lower than the original price. In other words, there is a cushion built in. So the stock can actually go sideways, even drop a little. And I've got a couple of slides that'll illustrate that on a graph in a moment. So there is some cushion built in. However, if the stock falls below 58, right, losses will occur. Remember, you do own the stock. So there are risk management techniques and exit strategies that are in place in case the stock does move against you. But our goal in the buy rate to generate income is to have that stock taken away and realize the max profit. Here's another way to illustrate what I just went through. Dollar General, great stock. You buy 100 shares at $112 per share, and then you simultaneously sell one call option. In this case, one strike out of the money, or the 115 strike. You will get paid $2.65 per share, or $265 for one contract. Okay, that's the scenario. What happened, or what can happen? Again, as I just showed on the previous walkthrough, if the stock goes down, the profits from the call you sold will help minimize the losses on your stock position. But if it goes below the break even, you will begin to lose money, and you have to have a management technique in place. As I said earlier, if the stock moves sideways, you can still make some money on the covered call option, and you can always hold the stock and continue to sell covered calls against it if the situation calls for it. And then finally, of course, if the stock goes up, your goal is to make the max profit. Remember, your profit is capped here. You get to keep the premium you received plus the gain in the underlying stock up to that strike price. Right? Those are kind of, again, the what if. So in this case, what would have happened? Well, at expiration, Dollar General closed at $119 per share. In this particular trade, you would have made $300 in capital appreciation. Remember, you bought the stock at $112 and you sold someone else the right to take it away from you at $115. So you made $3 plus the $265 in premium collected. That's $565 you made. That's the perfect trade. I don't care that the stock continued to go up. I don't care if it goes to 200. That wasn't my goal. It wasn't my objective. My objective was to create steady, safe income, and I'll move on to the next trade to continue doing that. Here's what it looks like, again, in our Tuesday coaching group. These are actual trades that were placed. And this goes back, well, it's getting close to a year now, June of last year. We used AMD as the example, and it just using the process we use, the filtering process and the techniques that we use, AMD came up quite a bit in the last year. So I want to walk you through quickly how this worked out. On June 18th, we bought 300 shares of AMD, and we sold 3 covered calls against that position. It wasn't a month later, or just about a month later, we closed that position using our management techniques, and we took in $603. That's 6.81% in 31 days. We then went out using our system. In August, we did the same thing. We were able to capture another $600 or 7.4% while the stock is moving sideways. We then did it again. Now we had some other stocks. AMD came back up on the list in November of 19. We did the trade again. We were able to make $417 this time. As you can guess, since I have the graph up, we continued to do it. In December, in just 10 days, our technique had us making 5%. And then I put this last slide in here kind of for fun, because when I created this, and the last time I did a webcast using AMD as the example, we had just opened another 200 share AMD position and sold 2 more covered calls against it. That was on February 4th. And you remember That's just 2 or 3 weeks before the sell-off that we experienced. Okay, so at that time, I had the slide and it said not sure where it will close, but just about a week or two into the trade, as you can see, not even a week or two, we were already up $375 on the trade. As it turned out, that trade was ultimately closed on February 18th for another $538. Okay, that's the power of generating a safe, steady income using the proper process and techniques to generate income. And it's very easy to do in your retirement portfolios. Okay, and each of those positions were closed. None of these were held to expiration. None of these trades that I just walked through were held to expiration. They were all closed based on a strategy that we use. We calculate the max profit potential, and we look to capture at least 80% of that. Of course, there are other nuances during the life of the trade that might make you act earlier or later, but that's what was done there. Very basic calculations, very basic way to generate that income. So it's over $3,500 in the last month. That's just on one stock. That's just the one stock. So that's the income portion. That's the provide. We went through part one of dividends. Part two was the covered call section. Right. So now we are through two fronts. Let's talk about capital preservation because I do strongly believe it's the most important. So when we talk about preserve, specifically what I want to talk about for a moment is what's called protective puts. And I'll say the same thing I said earlier about an option trade. This is a basic concept. If you own a car, if you have life insurance or health insurance or homeowners insurance, you know exactly what a protective put is. And I'll walk through it. The reason they're important comes from, and a lot of this builds after my conversation with Dr. D I alluded to in the beginning. I found a quote from my fellow Connecticut Yankee, Mr. Mark Twain. And if anybody's from Missouri, you don't have to type in. I know he was from there originally, but he lived in Connecticut and was buried there. So I call him a fellow Connecticut Yankee. He wrote, and I couldn't find or come up with a better quote. He said, "Don't just sit there and worry. Be proactive, do something, anything about what's worrying you so that you can gain information, focus, and control over the situation. I've suffered a great many catastrophes in my life. Most of them never happened." Okay. I love that quote for what we're looking to do. It just encapsulates everything we're looking to do. Be proactive about what's worrying you. In other words, protect your assets. How do we do that? Well, we can reduce risk by buying put options to protect either individual stock positions or you can protect your entire portfolio using put options. And I'll walk through both scenarios. Now, I'm going to bring up one slide that shows what a put option is. This is not meant to, it's not an options, course here. You don't have to be an expert. I just want you to have the 30,000-foot view of what a put option is. It's an insurance policy for our purposes here. Here's what it does. This x-axis is the stock price. The y-axis is the price of the underlying option. All you have to know is that the value of a put option will rise when the value of the stock falls. So as you see, if the stock falls in price, the value of my put option rises. It's an insurance policy. It's a hedge. So that's all. That's really all it is. So as I said earlier, if you have homeowners, health insurance, car insurance, heck, me and my wife even had pet insurance on our two dogs, right? It's there as a hedge. It's there to be prepared so that you don't have to live through those catastrophes that we talked about. Let me walk through just a quick case study of that. The time frame or the stock, it doesn't matter. It's the scenario I want you to take away here. In this case, it's Texas Instruments. So let's say you really wanted to be defensive on Texas Instruments. You can buy a put option. Maybe there's an earnings report. Maybe there's something else going on. Maybe the confirmed down call in the VectorVest system just came. There's a lot of strategic reasons to become defensive. But let's say you want to be defensive. You could go out and buy an insurance policy or a put option on the underlying stock. Now, how much you pay for that insurance depends on where you decide to set your strike price. So in a put op, remember earlier I said if somebody owns a call option, it gives them the right to buy a stock at a certain price by a certain date. Here, if you're long or if you own a put option, it gives you the right to sell that stock at a certain price by a certain date. So if I have the right to sell Texas Instruments at $120 per share, does it matter to me if the stock goes from 120 down to 20 or 50 or whatever it might be? I'm covered. I'm insured. It's not going to matter because even though the stock's going down, the value of my put option rises. So think of it where you set your strike price as buying your insurance policy. Where is the deductible, right? Most insurance policies have a deductible. You want no deductible, you're going to pay more. You want a little bit, you okay with a little bit of deductible? Then you'll pay a little less. Okay, so with the stock trading at right around 120, you can buy what's called an at-the-money put, or you could pay a little less and buy a 115 put option, which gives me the right to sell the stock at 115. If the stock were to gap down and continue to crater, I would be protected anywhere from 115 on down. But I'd have a little deductible. Let's look at a case study and see what actually would happen here. So let's just say we bought the stock on, there was a confirmed up, you bought it on 11/24, or maybe you even bought it earlier in the year, way down here. Either way, you followed a process that got you into good quality stock that's rising in price in a rising market. It is incumbent upon you, if you own it here or even down here, that this is now, yes, it's an unrealized gain, but the way you have to look at it is that is your money. You don't own it at this price, somewhere around, I don't know what it was, 90 something dollars, $98, whatever it was. If it's trading at 120, that's where you own it. That's the mindset I want you to have, especially if you own it way down here. That's an unrealized gain, but it's your gain, and it's incumbent upon you to be proactive and protect it. So using this purchase date, you've got roughly a 20% gain on your 100 shares. It's about $2,000. That's your money. Now, because we do our due diligence on every stock we own, we go out and we make sure we know when earnings dates are coming, because that's when we're going to really want to protect, especially large unrealized gains. So in this case, just as an illustration, I go out and I buy what's called an at-the-money put, or the 120 strike, meaning I now have an insurance policy. If the stock falls, the value of that put will rise and it will offset the drawdown in the stock. So what happened? Well, Texas Instruments gapped down after earnings. Even IRS stocks can have an earnings report where something's mentioned that makes the stock crash. In this case, your put increases in value, offsetting the losses on the stock. What I paid $423 for is now worth $1,128. It mitigated that drawdown. Well, here's what it looks like. Before earnings came, right, I had an unrealized gain of $2,000. Had I not bought insurance, had I done nothing, had I not been proactive, after earnings are reported, I lost half of my profit. Now I'm still up. That's great. But I don't need to suffer that drawdown. Why? Because I went out and I bought an insurance policy. So I lost $1,000 on the underlying, but I made $700 on the put, which means my overall position is still now down only $300 versus the $1,000. It's called mitigating drawdown. So you drastically minimize your losses. That's just one position. Here's another position from our retirement portfolio that we do on Tuesdays. It's just FNF. Again, it was a stock. Confirmed up call came. It made the list on one of our top searches, and we bought the stock, 47.5. We knew earnings were coming out. Now that looks like a big gap, but these are only $2 increments here, so we're okay. On 211, we bought two, because we own 200 shares, we bought two March 45 put options. It cost us $210 to insure a $10,000 position, roughly, just under 10 grand. Okay. On 214, earnings were announced. The stock gapped down. We had insurance, so we were able to evaluate, see what's going on. In this case, this particular trade, on March the 10th, the entire position was closed. Here's what happened. We sold the stock at 38.52. So we took an $1,800 loss on the underlying stock. But because we were proactive, we were able to sell the two put options at $7.30, which was a profit of $12.50, which means our drawdown was only $5.58, or less than a third of what would have happened had we done nothing. Okay, that's just two examples. I've got dozens of them. Okay. Jim says, why not use a trailing stop? And you can. You can use a trailing stop. Okay. Your account's going to be more active. There's nothing wrong with that, tightening trailing stops. But what this does is give you the ability to make the decision. Many stocks will go down and gap right back up. There are a lot of dividend paying stocks you can protect and continue to hold the stock. Maybe you've owned the stock for 10 years. Maybe you don't want the tax consequences. There's a lot of reasons why you want to be proactive during these searches. So I'm going to take a sip of water and ask you guys, would you rather own your possessions, your assets, with no insurance? Or would you insure your house, your car? Or you have to, I guess. Your house, your car, your family. Right? Type it in so I know you guys are still with me. Yeah. Yeah, of course. I know the answer, but I want you guys to type it in anyway. They're flying across here. Yeah, of course you would insure. It's very easy to do and essential, I believe, if you're managing your portfolio. Finally, and the last point I want to make is that you can also preserve by buying put options on the overall market. And when I say overall market, in this case, I'm talking about the S&P 500 or the SPY, which is the ETF that tracks the S&P 500. I mentioned earlier I kept a slide in there from a previous presentation, and I did it again here. I was doing this presentation, I don't know, it was before the sell-off. It was sometime in February of this year. And I was trying to impart the importance of being prepared if and when the market was to turn against us. At that time, when I talked about the SPX, it was still up. The sell-off hadn't come. The market was doing wonderfully good, and I kept saying to people, and I kept hearing in chat boxes and phone calls and emails, well, have to worry, the market's doing great, everything is great. And I said, don't tell me that. I don't want to hear that unless it's qualified by saying, well, and I'll zoom out on the screen a little bit here, because it's very easy to forget what happened in October of 2018, where we sold off 20% in 90 days, right up to Christmas Eve. Right? So don't tell me about this run in the market unless you're going to also talk about what can happen if you're not prepared. And so what happened? It took over a year just to get back to even. It took over a year for the market to recoup what it had lost. And yes, the market went up, and that's great. So at that point, I was urging the importance of being prepared. And what happened? Well, not that I predicted it or anything, or we predicted it. Well, in a sense, VectorVest did alert us, and here's how it worked. On this date, it was February 28th, and when the sell-off began, the confirmed down signal in the VectorVest program was confirmed. If you want to go even a little earlier, back on the 24th, the DEW timing system, which is another prudent market signal that we use in the VectorVest program. These are being proactive. These are your calls to strategic defense. So I zoom in even closer. When we talk about puts for portfolio protection, okay, on 228, the confirmed down signal went to a down situation. The confirmed call was down. Be proactive. Place an insurance policy on your entire portfolio. Good time to use a put option on the SPY, again, the ETF that tracks the market. You could have gone out, and I'm just using one contract, and at the SPY was trading at 296. Yeah, you would have paid $14 per share to insure whatever size portfolio. You could have bought 2 or 3 or 5 of these. It depends. Either way, you knew you were signaled through the VectorVest program for the confirm down and a few days earlier the DEW. It's up to you to be proactive. What happened? Well, when did we buy these? On 228. Not, what is it, 3 weeks later? 3 weeks later, if you had bought the March expiration, that option was trading at $67 per share. Okay, that's 5,300 bucks or 380% return on investment. And yes, then the market began to go back up, but you mitigated the drawdown and you don't have to wait a year to get back to even. This happened back in 2018, and there's a quick reason why I'm showing this. This was the 2018 sell-off I talked about. You could have done the same thing, whether it's 1, 3, or 5 contracts. It doesn't matter, right? At expiration, the options at $45, an option you bought for $6. This was the other big sell-off that we experienced back in October of 18. VectorVest told you when to be strategic. Whether you took your profits here or all the way down here, you mitigated your losses. And Elaine, one of our longtime subscribers, this actually does mean stuff to us here at VectorVest when somebody writes stuff like this. He said, because of your teaching, I hedged my portfolio at the end of January with puts, saved a section of my portfolio for just under $1,000. That sell-off was so violent that a small amount of put options netted him a very large return. Okay. And that was just a quick look at how quickly and violently the market drew down. So, just to wrap it all up, capital appreciation, income, capital preservation. Remember, I showed growth portfolio focused on high safety stocks. Now you know when this drawdown occurs in the underlying stocks, we have a way to mitigate that. Right? Remember, that's a 24.6% return on investment, and we compared it to the 8.5% return on the S&P 500. We then talked about our dividend growth stocks. Same thing. We had a nice 13% return, just slightly below what the S&P did, but we added in our dividends and we're able to generate an annualized rate of return of 18%. We talked about the ability to generate even more income using covered calls. In less than a year, we're up over $3,500. That's just one stock that we followed the process with. And then finally, we showed how to insure an individual position and how to protect your portfolio. And this is the slide I already showed, 380% return on investment. So those are the 3 core strategies that we believe every retiree must know so that they can retire with a peace of mind knowing they can grow their portfolio, generate a safe, steady income, and preserve their capital. Now, towards that end, if you wish to learn more how to do that, we have what's called the Ultimate Retirement Solution online course. Right? 3 core strategies, 6 modules to protect and grow your retirement nest egg. It's designed to take you by the hand, guide you through the method you need to grow and protect your portfolio and retire with peace of mind. And I just want to take a second, to walk through the 6 modules that come with the Ultimate Retirement Solution course. Very quickly, we begin in Module 1, Win Before You Begin. If you don't have the proper objectives, the portfolio allocation, your goals written down for you, and you don't have a plan or a process, you're going to lose before you begin. So we have to lay that clear path to victory. It's very important. First layer, the foundation of building and managing your portfolio. Portfolio, Module 2 is important because it walks through not only building but managing your portfolio. We go from the stock buying checklist to balancing your portfolio and setting up your plan, because it's not just buying the right stocks at the right time, it's managing those stocks once that portfolio is created. And we walk through it from A to Z on the capital appreciation portion. In Module 3, we do the same thing but only on the income side. We will walk through building your dividend portfolio, giving you the exact process and plans and techniques that I showed for the returns that we showed earlier. You've got to identify the quality of the dividend stock, the growth stock. There are certain strategies we use, and again, there's a different management technique or process that we use. Modules 4 and 5 are extremely important because it goes through what I just talked to. It's every retiree, every investor should be familiar with and applying the power of the covered call. We'll show you how to the what, when, and how to properly set up the trade, and how to manage the trade once you're in it. I've said several times throughout, I believe the most important module is right here. Because what good is all of this if you can't preserve your capital during times like we've seen since April? Now, since February rather. I know the markets are trying to rally, and the markets are back up, but there's still a lot of uncertainty, and I still think that that you need to be prepared because it takes a long time. If you lose 50% of your portfolio, of your net worth, that portfolio now has to grow by 100% just to break even. I use those numbers because it's easier to round them off. Okay, that's not what we want to happen to you. And then finally, all of that is useless unless you have a way to actually implement the plan. So in Module 6, we'll go through and we'll show you an exact plan, a process, a technique to generate the steady income, and to build on Module 2 and show you how to build a growth portfolio. Again, allocate the funds, and we have an entire checklist for you to go over to do that. Okay. So all very important, all key to building and managing your retirement portfolio. And here's what you get with the course. If you sign up for the course and you're interested in learning more about all this, we really there's a lot that goes with it. So with the 6 modules that I just showed, one of the bonuses that we give are 6 live mastery support sessions. So you get those modules recorded in what's called digital chalk. You have access to the modules and all of the resources that go with it, but we'll give you 6 live mastery support sessions. While the market's open, we'll help you implement what you learned in the module. We'll look at what you're doing now and guide you. And don't worry, if you can't make the live module, we will have it archived for you, and there's a recording of it, so you're not going to miss anything. Here's my favorite part. You will all be invited to, I alluded to our Tuesday retirement coaching group. We get together every Tuesday at 2 o'clock Eastern Time. We go through our portfolio updates. You can get access to our live, what we call the retirement income portfolio. That's where we do our weekly covered call trades. And you'll be invited to that for the duration of the course, so you can get a better understanding. What you'll get also at the end is a bonus module, and my friend and colleague Mr. Ron Wheeler does a great job showing you, if you want to take your income trading to the next level, he'll show you how to trade credit spreads to open another income stream with very high probability trades using leverage, so that you don't have to go out and buy a $150 stock to sell covered calls against. It's another, on top of covered calls, it's another great way to generate income. So very important. Here's my favorite part. On July the 10th, I walk about 50 yards up to our state-of-the-art training center, and we actually will live stream all 6 modules plus the bonus module for our live stream session. You can ask questions. Again, it's while the market is open. We go into even deeper detail, but it is a one-day look that is recorded and provided to you about a week or two, probably 2 weeks later. You have access to both digital chalk and the live stream for a full year after the course. If anyone out there is listening and is interested, and you are currently not a VectorVest subscriber, what we'll also give to you is what we believe is the best tool to determine market direction and how to find those stocks I was talking about. It will dramatically reduce the amount of time you spend building and managing your portfolio. That 60 days access to the intraday program is for new accounts only. So what do we get? We're giving a lot of stuff away for this course. You get the training course, regular price $9.95. You're invited to all 6 live mastery support sessions. Again, if you are new to VectorVest, you get 60 days of the intraday software. You'll get a bonus module that will open up a whole new door for generating income in your portfolio. The modules, again, the entire course will be done in a one-day live stream version where you can watch and ask questions and the like. And then again, we will invite you to that retirement coaching group session that we have every Tuesday. Okay, so there's a lot that's offered there. This is our URS online course. So the question you might ask is, is it worth the price? Well, we definitely believe that it is. The regular price for this course is $9.95. We're offering what's called the early bird special. You can order at vectorvest.com/URS. It's $5.95 is the course, but wait, we have a fast action bonus. Because you were kind enough to spend the time with us today, if you go now to vectorvest.com URS, we'll slash another $100 off. So it's going to be $495 for the course. If you order before we're done here today, and my colleague Brian D'Amico is going to come in and we're going to walk through any and all questions that might have come up. So that means you'll get a full course, the full 1 year course in digital chalk. You'll get the 6 live mastery sessions that are archived there if you can't make the live ones. And you'll have access to retirement coaching group. You'll also have a 1 year access to the live stream. So that's $495 only for those who register before we finish up here today. Now that price is actually even lower than our elite pricing. So if you're an elite subscriber, right, you would pay $497.50. So if you're considering joining up, save yourself a call in to our product support, and you can go ahead and sign up at vectorvest.com/URS, and you can get the $495 price. Now, they say there is no such thing as a risk-free trade in the markets, and there isn't. There is no such, no matter how safe a stock is, no matter how comfortable you are, there's no such thing as a risk-free trade. However, taking this course is actually a risk-free endeavor, because after the course is over, if you show you've done the work, in other words, at least you've watched the videos and the homework assignments and whatever else there might be there, and you're still not satisfied, we'll gladly refund the money for the course. So it is actually a risk-free trade. I think an important question that I ask, and you should ask yourself, is what will it cost if you don't do this? If you do nothing? How much money will you lose? How much potential profit will you miss out on? How much time and energy will you spend trying to do this on your own? Okay. Then ask yourself how your life would be different if you do it and it works. So there's a saying also that the best time to plant an oak tree is 20 years ago, so you can be sitting under it now enjoying the shade. But we all know when the second best time to plant that oak tree is, and that is today. So it's not too late to begin. To prepare yourself for retirement, order before the end of the webinar. And again, Brian and I are going to take some time, and we're going to answer any and all questions that you might have. And we'll talk about the dates and times and all there. So that leads me to the end. Thanks for taking the time. Stick around, ask any question that you have. We're going to answer any and all questions that were here. And I'm going to ask Brian to come on in and we'll chat with the folks here. Brian, are you there?
I'm here, Jim.
Great.
How are you?
I'm good, Brian. I'm good. Thanks for taking the time to help out.
Well, we had Rodney before you even finished. He was like, "I'm all signed up." So if you're the same as Rodney and you've signed up, in the chat box, just type in, I'm in, so Jim can see your name and we can welcome you to the class. Jim, I did want to share with you, you're streaming live on YouTube, and we had some comments come through just recently. From Jake. He says, Jim does a great job explaining this stuff. And then in capital letters, he put, this stuff really works with like 1,000 exclamation points.
Great.
And then I don't know the first name. It just says B. And he says, he was replying to Jake. He said, indeed, I agree. I'm a longtime VectorVest subscriber. This stuff really works for me. So some nice comments over there in the chat on YouTube. So welcome to all of you who have joined. We do have a bunch of questions that have come in. So like Keith, Stan, Tim, Jim, we'll get to your questions definitely. I think one of the main questions we get, Jim, and I think the thing that made me think of going to this first was you showed a slide just a moment ago with dates on it. That was a question from Jim. He wanted to know what are the dates of the live sessions if they did want to attend those live sessions. And it looks like you got it right there.
Yeah. So yeah, the live sessions. It's going to be every Monday. Well, except for the first one, obviously, Friday, May 22nd, and then the next five, and the bonus session as well will just simply be every Monday at noon. Every Monday at noon, starting on June 1st. Again, with the exception of that Friday, May 22nd. I believe that's for Memorial Day, if I'm not mistaken. And so every Monday after that is when we'll do that. And then the live stream, of course, is going to be on Friday, July the 10th. So that's the schedule there. Again, while the market's open, you can ask, and it's great to have the live session to go over the information from the modules.
All right, fantastic. So, Jim, if somebody is not able to attend live sessions, do you think they could still be successful, though?
Oh, without a doubt. Yeah. Listen, the live sessions are great. And that's why we record them and we archive them in what's called digital chalk. If you sign up or if you have signed up, and it doesn't take too long, but you'll get an email with all the instructions to get there. There are a lot of resources that are available there. And That's why we record them. And so later on, usually that evening, you will have access to the live sessions. So you don't miss anything. And not only that, by the way, what I didn't mention is there is a dedicated email bin for those who sign up, where we will see your questions and either answer them in a return email, or we get oftentimes we'll take them right into the mastery session and answer them there.
All right. Uh, let's see. So the next thing. So maybe can you go back to that slide that I think there's a slide you had that showed the what people get, if I'm not mistaken.
Yeah,
But I think people just
that one.
maybe there wasn't.
Was it
Sorry
that?
about that, Jim.
Was it that
Making
one
you
there?
flip all around over there.
Was that the
So
one right there?
I guess so. Yeah, I think that's the one. So that those of you who are asking, like, just a reminder of the things that you got. There it is on the screen. We'll leave it up there for a few seconds, and then we'll switch it back to the slide, probably the next sliders, so you can see where to order. I did put the link in the chat box for you.
Great,
So
thanks.
Jim, there was a couple of people from outside the U.S. It looks like Keith is outside the U.S. And I think if I read his question, he and Tim from Canada. So they wanted to know, he says, Tim specifically, I'll just read his question. He says, seems like this is geared towards U.S. portfolios. Does it work for Canadian equities as well?
Yeah, that's a great question, and we get it a lot. And here's what I'll try to make the short answer. The answer is yes. The concepts of finding safe, high quality stocks in a rising market, using the VectorVest program to find both of those to understand the trend of the market and the quality in the right stocks. So yes, that is global, right? That is worldwide. The one part, and that goes for dividend stocks as well. While you might not see that exact blue chip dividend growth portfolio, there are a lot of great dividend searches in our other platforms. So it may not be that because we're using the U.S. indices there, but there are great searches using dividends for the other platforms. The only thing that's a little bit different is the option side, because options in some of the other countries, including Canada or UK, are a little less liquid than they are on the US side. Okay, so unless it's, one of the bigger stocks that has some kind of liquidity, it's a little bit harder to trade the options on that side of it. It's not impossible, but the liquidity is not there. So other than that, the concepts and techniques are applicable all over the world.
All right. And to answer another question is, the registration does close. Like, the registration closes, I believe it's Tuesday. I'm not, I'll double check, but actually price goes up Tuesday of next week. So price will go up on Tuesday of next week. And let's see, registration closes. Let me just double check my calendar, Jim.
Yeah,
Thursday.
there you go. Yep.
Thursday of next week. So, and then you won't be able to register for this course with the live sessions. So price goes up Tuesday, registration closes Thursday. So get in while you can. All right. So Jim, we had some other questions. I got Keith, Stan, Tom, Lewis, William, and so on. But I did want to say I just happened to look over at the YouTube stream. I did want to call out Shailesh said I'm in, so I didn't want to forget that. We have Craig said I'm in, Patrick is in, Gar is in. So those of you who are joining, welcome aboard. You should be getting an email probably instantaneously. Tim just said I'm in. You should get an email with a link to with all the dates, all the times, everything you need is going to be in that email. So check your inbox and your spam folder or junk folder because it might be in there as well. All right. So Jim, Keith had typed in, he said, do you recommend a minimum balance in a portfolio before going through this course?
That's a question we get a lot, and it's a great question. I listen. We have a lot of folks in the chat room. We have a lot of folks who take the course, and there's no way for us to know the size of anyone's account. But what I would tell you is this, without putting a number to it, if you have a retirement nest egg or a portfolio, and I guess I could put a number. Listen, if you got a few grand, it's hard to build a portfolio of high quality stocks of 5 or 10 positions. Okay, but if you have a retirement nest egg that you're looking to build and manage, and again, it's hard to put a number on it. I mean, we have people from anywhere from 20 or 25 thousand dollars to a million or more who use these techniques. So anywhere in that range is a great starting point. It's hard to put an exact number on it though.
All right. We had a few people type in saying, when I go to the website, it says 595. So when you go to vectorvest.com/URS, the first page you see will say 595. But once you click the register button, while we're live here on this webinar, it will show you the 495 price. All right, so as Jim's showing you, when you go to the site, it'll on that page, you'll probably see a 595 rate. But when you click on register, you'll see that there's a special bonus for right now that says buy now bonus, limited time offer, 495. And you can see it says 495. So you don't need a discount code or anything. While we're live here, you get that price. And this is even lower than the elite pricing, right, Jim? You said it's 497.50 if you're an elite member.
That's right. For an elite member, the regular price of the course is 995, so you would pay 497.50. So if you are an elite member, you can go ahead and sign up now. Already, we're saving and making money. You save $2.50. Do it now.
All right. While I was talking a little while ago, we had a bunch of people. They heard me say welcome to other people who have joined, and I guess they didn't want to be left out. And we love it that you typed it in. We got Larry says I just signed up with a bunch of exclamation points. We got Edward, Michael, Jim, Ed. So we have Edward, and then Ed, and amazingly, both people have a last name that begins with MC. so welcome to both Edward and Ed. Great to have you here. All right, so Jim, some other questions that came in. I can answer this one. Tom says, where do you order? Tom, we love those questions. The answer is vectorvest.com/URS. I put the link in the chat box, or you could just type it into your web browser. So great question.
Yeah, that goes for Mortiz too, Brian. I just happened to see that same answer. He's asking where to sign up, or please contact me. Just go to see that one near the bottom there. So yeah, you just want to go to the link.
Good eyeball there, Jim. Jim, Tim wanted to know about how long are the sessions?
The sessions, the modules are about an hour long, each module. The live mastery sessions will usually run anywhere from an hour, and a lot of times it is some good stuff and good questions, so they do go longer sometimes. The most that'll ever go when I'm doing them is an hour and a half, and that's rare. Usually hour and 15 minutes or so is about the length of each mastery session. Each module is about an hour.
All right, and you said there's a private email address for this course that if they can submit questions ahead of time if they wanted to, right?
That's right. Yeah, I think it comes in the email.
Yep.
Whatever. Yeah, there's the email bin. So we try to focus on that and get back as soon as we can. And like I said, either we'll answer it via email right back to you. Often we'll do that. Sometimes, a lot of questions are great questions, and we think if you have them, probably a lot of other people do. So we'll use them in the actual mastery sessions. So either way, we'll get to them.
All right. So we had a question. When you were going through the offer at the end, you were talking about VectorVest software, and you showed some things during today's webinar. The question that came in from Stan was wondering, all right, well, what other add-ons do I need to implement these strategies? And I'll kind of rephrase part of it to say, can they be successful even if they don't have any extra add-ons?
The answer is unequivocally yes. You certainly can. Again, the concepts and the core strategies are to find the right stocks at the right time. The management techniques that come, some of them I know a couple. I saw Profit Locker Pro. I mentioned it, and I saw it in a question or two. Is is an add-on, but it, it's a great system of managing your retirement portfolio. But you don't need it to successfully manage it. Right? You could use something as simple as rec equals sell. What we do is we use prudent slash conservative exit strategy on our management techniques, and so that's all you would need. So you don't need the add-ons. It's great to have VectorVest. As we said, it's the best tool, first of all, first and foremost, for market trend and knowing when to buy, and then finding the type of stocks I talked about today.
All right, and then Henry, if you're not a current VectorVest member and you did want to continue after, first off, we'd love to have you. It's a great tool, so we'll give you some discounts and things at the end of the course. Just the base VectorVest software, like with no coaching, from Jim. You can get an end of day version of it for I think it's like $69 a month here in US for the end of day data. There's some other services that we've got. Jim will talk to you about it at the end of the course, so that way you can kind of see what it's about during the course and make a decision at that point. All right, so Jim, we had let me flag this here. Now, one question that came to my mind, Jim, because like today you taught a lot. Like, I mean, there's a lot of content that you gave people, and somebody might be sitting there thinking, all right, well, what's the point in taking the course? It seems like Jim just taught me all the stuff I might need to know. So if somebody's sitting there thinking that, like, what would you say that is in the course that they would get in addition to the great stuff that you taught them today?
Yeah, a lot of it is what I didn't go through. A lot are the management techniques, the times where we recognize the strategic defense systems there. I quickly went through the setups for the protective puts and the covered calls. Module 4 will walk through all of the management techniques. I didn't touch on any of the management techniques of these things because I can't do it in an hour. Every trade, every setup, every management technique. And so I mentioned in the beginning, I have come to a point where I can't say build your management portfolio without saying, well, I can't say build your portfolio without saying build and manage. So we walk through basically building it and some of the macro view of how you generate income. But there is more to it with the actual trade setup, and there's a process, a technique, a risk management technique that is the key to success. It's an entire process, not just building, but building and managing, and that's what we focus on.
All right. So it looks like the last few questions that I have are actually more content related to like strategies and such. So I'm going to grab those in just a second from, I believe, Lewis William Donald. So I think you guys were asking more specific questions about what Jim was teaching today. Obviously, I mean, he can't get in there, and if it's something that he goes into great detail in the course, but if he's got a quick answer for you to kind of set you down the right path, of course he can help you out, but he obviously can't get in there and like teach you the course in today's session. So let's see. So Jim, we got one from Lewis. He says, what are your thoughts on safety of stop loss orders if we have another flash crash?
Yeah, that's a great question. Listen, if we we haven't seen one of those in a while, but a flash crash, if you have stop orders in, And again, I could talk for a half hour on just order entry. But if you have a stop order in, let's say you own ABC stock at $30 and you put a stop order in at $28, and we have a flash crash and ABC stock opens at $10 a share, that's where you're going to lose your $30 stock, is at $10 per share. Because remember, a stop order, you put the 28, that simply triggers a market order. And so the answer to that is a stop limit order. Right? The answer is a stop limit order. Now, the problem with that is you put a limit order in at 28 and then say your stop is, say, $25 per share. Right? That you're not going to sell that stock less than 25. Well, what happens if it opens at $10? Nothing. You still own it. So that's the risk you take, is that you don't get out of it at all. The short answer to your question is, uh, the only way to be prepared for a flash crash, well, I guess there really is no no exact way, but having protective puts, that's the other thing about puts, whether it's a flash crash or news or an earnings report or anything that it might be, having a put option, that insurance policy, is really the only way to protect your portfolio. And specifically for a flash crash, it's kind of hard to listen. The idea of a flash crash usually means that it crashes and then comes back, right? Because the tape is all messed up because of the prints that come up. But I don't want to get too far into all that. But put options are the best way to go. And towards that end, real quick, Brian, if you, was you looking at the question, so I did see a question. So somebody mentioned, well, what if you're buying protective puts and you don't need them? Isn't it costing you money? And of course it is. And I want to be clear that this is your net worth, your retirement nest egg. If you have to pay a few $100 or $500 to protect $100,000 portfolio, or even $1,000 or $1,500, and of that trade you lose $600 or $700 out of that trade, yes, you will. But what if you did nothing? I gave the best examples I could if had you done nothing. Right? I pay Geico for my car insurance for mine and my wife and my two boys the 18th of every month. When I pay them, I don't get angry because I just had to pay them. I don't get angry because I didn't total my car this month. Right? I don't get angry because of that. And that's how I want you to look at insurance policies for your portfolio. If I lose $500 on 100, 150,000, or 1,000, whatever it might be, on my account, protecting my assets, I'm fine with that, because as what they say about insurance, better to have it and not need it than to need it and not have it. Sorry about that rant, Brian, but I had to get that out.
No, sounds good. Good information. William, you were asking about how to pick the strike prices for the different calls and puts. That's actually very rules based, and Jim's got it all set up and teaches it in the course.
Yeah,
I mean, there's some different things you consider, Jim, instead of just saying pick this one. Like
w-
you kind of.
without a doubt. And that's what I was alluding to earlier. There's more that goes into the management techniques, and yeah, that's all part of the course, definitely.
All right. And let's see. George, it was the last question we got before we start to wrap things up. George is saying, I guess he has his account size might, uh, he didn't specify, but I'm guessing he feels it might not be large enough. He's saying, can I just buy options?
Yeah, listen, you certainly can. We have education that will help you to do that. Of course, the beauty of options is leverage, right? That's the power of options. It's leverage, meaning that you can get higher percent gains for less cash outlay. And so we do have that. Keep your eye open. We do have option courses coming up. I guess, Brian. I guess that's the best answer I can come
Sometime
up
soon,
with.
sometime
Yeah,
eventually.
yeah, coming at some point.
Well,
But the
we
short
had
answer is
Robert
yes. You
sneak
can.
in, Jim. He's like, before we were signing off, he snuck in and said, I'm in.
Oh, great, Robert. Good job. Good job.
So there might if we missed any of your names, I apologize. But welcome to all of you who are in, and I'm gonna actually pass it over to you, Jim, to kind of wrap things up for the day and say whatever you want to sign off.
Well, that's great. Thank you, Brian, for helping out. And thank you all who are still here in the room. Thanks for taking the time. Again, you can sign up at the link that you see there. It'll be open for a little bit longer. I do look forward to seeing you. If not, stay tuned. Maybe the next time. But more importantly, please, everyone, stay safe, stay healthy, and we'll see you at the next session. Thanks, everyone.